Continuing our explorations of deferred income, we are doing an additional piece of work, a new different piece of work, let's say for a different customer, and we invoice for it. If we invoice for the work, then let's say the amount is 4, we're going to recognize a new asset, a receivable or debtor. So the customer will pay us sometime. So we've got an additional asset for that amount, but we're going to treat the whole of the amount as deferred at this stage. So deferred income is a liability, and the amount is 4, so we're also recognizing an additional liability of 4. So the consequence is our assets went up by 4, our liabilities went up by 4, so we've got +4 on the assets side and an additional 4 on the liability side, but the liabilities are a minus. So we've grossed up the balance sheet. So our assets and liabilities amounts separately have both gone up, but they've both gone up by the same amount. Therefore, they're exactly balancing. Therefore, our net assets are still 13 as they were before we did that transaction. So new asset, a new liability, and the overall effect on net assets is none because we're deferring the amount. And has the cash moved? Well, no. We've written up a piece of paper. We could say we've sent it to our customer, although they will be paying, so we can recognize the asset. No cash has flowed in this period, and there's no income or expense to recognize either. Now, let's say in relation to that same contract, we write down the amount. So let's say there's a discussion or a dispute and we agree with the customer, okay, you don't have to pay us all of that. We'll write down or write back or issue you a credit note. You only need to pay us 2, not 4. So the write down is a reduction in the receivables. The receivable reduces by 2. The customer, we have agreed with the customer, owes us not 4, but 2 now. So assets go down, and within this total deferred income of 7 that we had before, 4 of it relates to this particular account, this particular piece of work. We need to reduce that as well. So reducing that by the same amount of 2, and we've now got a smaller balance sheet in terms of its individual items, but again, no change in the net assets. So we're reducing the receivable and we're reducing the element of deferred income that relates to that piece of work. And again, no change in cash. And again, this is not income, nor is it an expense, so there's no effect on the net assets and no effect on equity. So the reconciliation for both these cases between profit and cash flow is there was no profit nor loss, and there was no cash flow. So, and there were no reconciling items.